this life, there's no obstacle that can't be defeated. For every tyrant, a tear for the vulnerable. In every loss, all the bones of a miracle. For every dreamer, a dream we're unstoppable. With something to believe in. Monday left me broken. Tuesday I was through with hoping. Wednesday my empty arms were open. Thursday waiting for love, waiting for love. Thank the stars it's Friday. I'm burning like a fire gone wild on Saturday. Guess I won't be coming to church on Sunday. I'll be waiting for love, waiting for love to come around. We are one of a kind, irreplaceable. How did I get so blind and so cynical? If there's love in this life, we're unstoppable. No, we can't be defeated. Monday left me broken. Tuesday I was through with hoping. Wednesday my empty arms were open. Thursday waiting for love, waiting for love. Thank the stars it's Friday. I'm burning like a fire gone wild on Saturday. Guess I won't be coming to church on Sunday. I'll be waiting for love, waiting for love to come around.
Hello, everyone, and thanks for joining us today. My name is Will Follett. I'm the producer for BizNow's Midwest Market, and I'm so excited to welcome you to today's webinar, 2025 CRE Capital Markets and Fundraising Outlook. Should be a terrific discussion. It's obviously a timely one, and we're really looking forward to hearing about what everyone is working on and thinking about today. We have a lot to discuss, so just a couple quick housekeeping items on our end before we get started. First, huge thank you to the folks at Agora who helped us put on the discussion. Looking forward to hearing what Asaf and the rest of the team are working on throughout the panel. From a logistics perspective, all attendees are on mute and without video, but please feel free to say hello in the chat. Let us know where you're tuning in from. Feel free to share any questions through the Q&A section. Time allowing, we'll try and get to as many of those as we can as we build out and proceed with the discussion. If you miss any of the panel or want to take a second look, don't worry, replay will be emailed to you immediately after we wrap up. As a reminder, you can always find this event or any of our other programs over at biznow.com/webinars. We have a really great panel today. Really looking forward to hearing what everyone's working on. Greg Rollman, Managing Director at Triperian Holdings, Emmy Adachi, Managing Director at Heitman, Jim Hallwell, Managing Director at Principal Real Estate Investors, and our moderator for today, Asaf Ross, VP at Agora. Asaf, happy to kick it over to you, and we can go ahead with the discussion. Take it away.
Thank you so much, Will. I really appreciate it, and everybody coming in and taking the time. It is a timely discussion, right? At Agora, we're a real estate investment management platform. We provide software and services for real estate investment firms across the U.S. And as part of our work, we've taken data from anonymized data from around 600 different real estate firms that we work with to try to understand what's going on in capital markets right now, especially when it comes to fundraising and capital allocation. Although the data always speaks, and you can always download this report on social media or on our website, I do like having the experts speak to the data and give some more context to it. So I want to thank again the panelists that are coming here and speaking on behalf of the professionals of the market. And we'll kick it away just to start the discussion with Jim today. So Jim, you know, as part of the report, right, we were looking at some of the capital inflows. So like, what are the sources that real estate investment firms today are raising capital from? And how are they kind of structuring their deals, you know, with the interest rate environment, with everything happening around administration changes, like these things have a tendency to change. So yeah, Jim, what are you looking at as the most significant capital inflows today?
I'll navigate that with where do we see the inflows going to right now. And capital tends to flow into those driven sectors where there's perceived landlord pricing power. So what are the beneficiaries of those capital flows? Data centers would be top on our list. Age-related housing, that could manifest itself in senior housing, age-restricted, 55 plus manufactured housing, niche industrial products. Notably, iOS or industrial outdoor storage has been the beneficiary of capital flows. And lastly, maybe a little surprisingly to some, more capital wants to go into retail today than maybe had been historically. If you look at retail, in 2010, it was about 25% plus or minus of the NCREIF index. Today, it's around half of that, around 13%. So retail holdings in the institutional, as measured by the index, has gone down quite a bit. I think you'll find that go from 13 to maybe 15%, maybe 17%. Most people on this line, their retail holdings have probably demonstrated pretty good landlord pricing power, and they're probably more inclined to increase it rather than decrease it. So that's not an all-inclusive list, but those are kind of top of mind where we see the capital flows going.
Yeah. Emmy, what's your take on this? What are you seeing in the market right now when it goes to Hateman?
Yeah, so I was going to speak a little more from a strategy perspective. We're seeing a lot of investor interest in value add strategies. So our value add series of funds has done really well. We're also seeing a lot of interest in high yielding debt funds. And, a lot of investors who like separate accounts, institutional investors who are really interested in how they can take advantage of market dislocation and potential distressed opportunities. So we're seeing, a lot of capital kind of forming around those different strategies.
How's it work for you guys, Greg?
Yeah, so I think there's a couple things that we're seeing. So, I agree that with the sectors that Jim brought up. I think one other sector that was historically kind of out of favor over the last few years, but is seeing a lot of investor interest now is office. We've been bidding on some office in gateway markets, and it seems like for not like true Class A office, but still for good quality office, that there is a real market there, and that the processes that we've participated in have seen 10 plus bidders. And I think that specifically in terms of where the capital is coming from is a lot of family office investors. So not just high net worth, but like the ultra high net worth family office kind of capital. So they are continuing to deploy. And I think another thing that they're interested in too is, to Emmy's point, private debt. We're continuing to see a lot on the credit side, and also in preferred equity, which kind of straddles both worlds.
Yeah, and this office take is extremely interesting. We also saw in our report a trend towards this type of, like you're saying, not Class A plus or Class A offices, but actually conversions of Class B offices or value add into Class B offices, making them more robust and kind of shifting them towards the Class A mark, which has been, again, pretty interesting in terms of capital inflows with what's happening with the administration right now. I think it's an opportunity of a lifetime, not an oracle, but it just seems this way. If you make right decisions around office, for us, at least from the data, it shows extremely interesting capital flows right now. Now, I'll jump right into the second question. And I think this is something that usually, multifamily has been a big word. It's been a big sector for many years now, but especially for the past few years. And what we see in the data is about 65% of total capital raises, around 65%, went towards multifamily, right? And I want to understand from you guys is, do you expect this to continue into 2025, or are we seeing any change with that? And Greg, I'll let you lead with this question.
Yeah, so I think that's an interesting data source that you have. Also, anecdotally, I have some data that kind of backs that up. So just to take a step back in terms of what we're doing here at Triperion, I'm the head of acquisitions here, and we're investing in JV equity, co-GP, preferred equity. So a lot of the deal flow that we're getting is from brokers reaching out to us or sponsors reaching out directly looking to raise equity. And I would say that looking at the deal flow that I've been getting in the last month or two, I agree that multifamily is the most common asset class that people are trying to raise for. But we have been seeing a lot of retail, still continuing to see a lot of industrial, some hospitality. I think that things that are missing probably are office and data center. I think data center maybe is just a limitation of our data set because we're kind of a smaller equity check investor targeting $7 to $30 million equity checks, and data center is just a kind of a more institutional world. So, you see everyday articles about a lot of investment in data center. We're just not seeing that right now, but I think that'll continue this year. And on the office side, I'm not seeing as much on the fundraising of people reaching out to me, but I think that's in part because it's very challenging, I think, to fundraise around office right now. So the people who are really investing in office are people who have a more discretionary source of capital, investing either through a kind of broadly diversified fund or a family office. So I think that to answer your question, yes, multifamily is always going to kind of be the leading asset class in terms of fund flows. But yeah, I think that based on what I'm seeing, there's going to continue to be a lot of interest in retail and office and probably data center too.
Yeah, and I think Jim has a lot of insight into data centers, especially. James, what are you seeing with data centers right now, and how is it gaining interest of investors?
Well, again, it comes down to landlord pricing power. And if you're in the data center business and you have a pretty good piece of dirt and you have power, you probably have a tenant. And the rental rates just keep rising on a monthly basis. And most people think that runway will last a little bit with AI. And there's a multitude of reasons that many on the line know. So we think that has some continued runway. And there's a lot of, it's funny you mentioned, I think if you do it a quarter or two or three from now, you're going to see a little bit more of a shift from multifamily and maybe into data center. I'd be interested to take away a couple of quarters from now. One of the things that's off of why you'll always have multifamily, kind of as Greg alluded to, there's just a lot of very good multifamily closed-end fund operators that are raising their third, fourth, or fifth series of funds. So that and a lot of them have just there's recent vintage where they just raised it. So I think that might dissipate just based on the life cycle of those very good operators raising their funds, and you've had a lot of new data center entrants raising funds. So I think you're going to see a little bit of a shift, if I had to guess.
Yeah, and we're definitely going to touch on that data every quarter. It's going to get updates and see what's going on, where the money's flowing, and seeing those shifts. I think one of the things that we've seen in the recent quarter in Q4, and this is where I think Emmy is going to have good insight, is we have seen some slowdown in fundraising in Q4 when it came to both investors deploying equity, but also real estate investment firms actually raising capital or having open raises. And Emmy, I'd love to get your take on that. What do you think is this kind of slowdown in Q4, and what does that show for the future into Q1 and the rest of 2025?
Sure. So obviously in Q4, you had a lot of uncertainty around the election, right? So people kind of holding off on decisions until the election was over. By then, you're mostly through the year. I think besides that, there were questions about interest rates. People were just generally waiting for more clarity on the market. I think there were still some people, we would argue that valuations have corrected appropriately, but I think there are still some people who have been hesitant to get into the market or deploy or even commit because they're not sure if it's a good entry point for real estate. And we actually think it really is. So I think you had all those factors contributing to a slowdown in both deployment and fundraising. Although actually, I will say, based on the Real Capital Analytics data on transactions, we saw a pretty big ramp up towards the end of the year that brought that number in for 2024 about 8% higher than 23 levels in terms of total volumes transacted. So we're expecting, as we look into 25, the issue is usually you've got some resolution from the election that helps with the uncertainty piece. But with the flurry of policies that are being enacted and then retracted every day, what we're seeing is potentially some more uncertainty creeping into 25, which I think we all hoped wouldn't happen. So we'll see how long that lasts. But I do know that there is a ton of capital waiting to deploy. And, in many cases, it's a good time when the market's dislocated. If you have conviction, it's a good time to deploy.
Yeah. Greg, how do you guys handle all this uncertainty in Triperion? How do you make your investment decisions? How do you make your raise decisions with the current state of the market?
Well, I think an advantage that we have being a relatively smaller or mid-sized investor relative to Heitman or Principal is, given the volume of deals that we're doing, we're really less of like an allocator and really more of a kind of a bottom up versus top down investor. So, at the end of the day, it's still for us taking a look at every deal individually and then just making sure that the deal has, if you want to think about it on like a cap rate basis, that there's some kind of pretty meaningful spread from the stabilized return on cost to whatever the market cap rate is for that kind of deal. So, we're continuing to stay disciplined on that front, and we think that there's still a lot of opportunities, especially in the kind of middle market. And even though there is uncertainty in the market right now, what's kind of interesting, I think, is that uncertainty often means that debt gets more expensive. Not necessarily from the base rates decreasing. I mean, you've seen rates, decrease in the last couple of weeks, but spreads have actually still remained pretty tight. I think I just saw that, Fannie and Freddie have continued to lower spreads on, their products. So, even though rates have basically round tripped over the last year, they're basically where they were last March. I think spreads are a bit tighter. So even if there's uncertainty, it's still relative, for us to invest in something like multifamily, we're still able to do that just because of kind of where the pricing is on the debt side.
And Jim, how does it look more on the institutional side?
No, I would agree with what Greg said. We always like to allocate capital into high conviction areas. Don't deviate from your style box or don't drift on your strategy. So we're just going to continue to allocate most of our capital into those high conviction areas. You'll always do a tactical investment outside of those if you think, okay, it produces great relative value, and office might be one of those. But Greg is accurate. The market is more efficient today, I'd say a year ago, 18 months ago. Construction loans provided great relative value. Spreads were up. It's like, well, why do a development deal when I can do a construction loan at 400, 500 over SOFR and get a great multiple? The world has changed a little bit. Spreads have come in, and so the easy relative value decision is it's less clear than it had been a little while ago. And Greg, I assume you agree with that general premise that the market's pricing a little more efficiently relative to public and private and debt to equity.
Yeah, I would agree.
I mean, what's your take on this?
So I would say when we're thinking about capital allocation, we're right in this environment, we're really just getting back to the basics, right? Because we're in this higher interest rate environment. You're not going to have cap rate compression to bail you out. So you really have to be, have a solid fundamental basis for the investments that you're doing. So kind of like Jim said, I mean, we continue to stick to our guns, in line with the strategies we believe in long term. But again, I think we've really come back to the fundamentals again. and making sure it's a rock solid investment from that standpoint, because you're not going to have all kinds of financial engineering to create the returns for you. You're going to have to create the returns through the incomes at the property and the property operations.
And this is an interesting take. Like all three of you are talking about sticking to the fundamentals and doing what you know how to do best. But how do you do that and take advantage of, for example, distressed assets, right? How can you a balance between both of those decisions, right? Because you're saying I'm in my fundamentals, but I also need to have my eye open always for a distressed opportunity, which won't always necessarily be within your, sticking to your basics.
Yeah, I think that you have to really, there does have to be some, understanding. You need to have some good institutional knowledge. We wouldn't just jump in because an office building is a great price per pound, right? We would need to really understand that investment and believe that that's a good investment at that price. Because even if it's discounted by 90%, it may not be a good deal. So I think, again, it goes back to truly understanding, digging in, understanding the investment itself, the positioning of that asset in the market, the pricing, and the outlook for the asset. So I think they don't have to be mutually exclusive. I think that we've been able to find some distressed deals that are in our wheelhouse, where we feel like perhaps we do understand what is the long-term outlook for this asset, and we think it's positive, and we think we're getting a good price on it now.
And I'll jump right into kind of the next question, and I'll let actually Greg lead this one. What it's a more like a stick to the basics market, right? And again, all of you said that, and still you still need to raise capital, right? You still need to have money to deploy. And again, Greg, what are some of the, I would say, the innovative fundraising or investment strategies that are kind of helping your firm stand out in a competitive market, right? There's a lot of players, a lot of firms out there trying to do different things. What are some things that you're doing in terms of fundraising that really help you stick out?
Well, one strategy that we have that I think has resonated with some investors is our continued focus on preferred equity. We've been able to deploy, a couple of preferred equity deals over the last 18 months or so, which we think is kind of a good mix in this environment of, still getting, mid to high teens IRRs while being at a discount to a market basis. And specifically on that, we've also, to use the phrase everyone's using here, we've tried to remain disciplined in terms of doing pref behind, fixed rate loans, making sure that we don't have any exposure on our back leverage by being behind bridge or something like that. So, focused on that kind of higher yielding credit side is something that I think has done well for us, and that I think in this environment we'll continue to be doing that this year, and I continue to see inbounds for that.
What are some of the things, Jim, that you guys are doing at Principal?
Yeah, stuff, it really comes down to, and I know there's some emails, there's some marketings and fundraisers on the line. The largest driver in a successful fundraising is an interesting strategy, a great historic track record, and great historic returns. You can get, clever on some other elements, but if you don't have that, it's going to be, pretty daunting fundraise. But, Greg mentioned what are some strategies we might pursue in a fund envelope to make it more interesting. Co-GP is a very interesting investment strategy that we're doing more of. Most investors are getting more sensitive to gross to net spreads, and that's an investment activity that really shrinks that. In fact, you're the beneficiary of a promote versus paying it. So those are some things, but really, if you don't have a great story, a great strategy, and a good track record and good customer service, you can get as creative as you want. You might not be successful.
Yeah. And I feel like, again, to what all of you are saying, it's first of all, it's in the fundamentals of the deal. It's all in the numbers, and then it goes to how do I market well, or how beautiful my brochure looks, right? Or what a great video I did, which I completely agree on. And I would say, and this is something more for actually for Mike, for Emmy, sorry. So when we were looking at existing capital, right, that you guys have at Hateman, and you now need to make decisions, right, on where do I put this money right now? Where is it gonna, how much of it is gonna go where, and how this pie is gonna be kind of split up in terms of investment decisions. How does that process work specifically also for you at Hateman? How do you make those decisions? What are the calls that you're making?
Are you talking about by sector, by market?
Mostly, I would say mostly by sector or
Okay,
market, but generally
yeah.
speaking, asset class as well. Like, how are those decisions made?
So it's a combination of qualitative and quantitative factors. So we're running models to determine optimal portfolio allocations. And then we're also balancing that by using what we have a great depth of knowledge on our team within each property type. So we have people that specialize in a property sector and they know that in and out. So they can opine on whether or not the forecasts that we're using or the data that we're using accurately reflect the sector's prospects. So we put a lot of thought into our sector allocation strategies. And so again, it's utilizing both of those things to really come up with the ideal portfolio construction for any given strategy or fund. And from there, then we're always tinkering with it, right? And we have to align that with also where are the opportunities, right? It has to be feasible and executable in the market. So again, there are many layers to it, but it's a very careful process that we take on internally.
Mm-hmm. How does it work in principle, Jim? How are those decisions being made? Giving people a look inside that room where the calls are being made is, I think it has great value.
Oh, I think there's many parallels to what Emmy just said, that we embrace. If you're running a fund, you have to be benchmark aware. And if your benchmark is industrial at 40% and you want to invest 20% or 80%, depending on how returns go, and you call it wrong, that you're going to have tracking error, and that's not going to age well. So there is an overlay of not taking too much tracking error off your benchmark, and then overweighting, underweighting slightly off of that benchmark based on where you have the highest conviction areas. And the funds that do well, it's like, okay, if I overweighted iOS, for lack of a better word, in 2019, you were a winner. Okay, and you're going to look very, very good. If you overrated Office, you're looking less good. So, you do have to be benchmark aware, and not take too much tracking error, but do those overweights on the margin on the high conviction sectors.
Cool. Thank you. And I do have one question here from the audience. I do have a few, but one of them it's been interesting. Greg, you spoke about increased investor interest in office properties. And then the question is, Jim and Emmy, are either of you seeing that same interest in your conversation or even in your deal flows?
Yeah, I'll start and just answer quickly. The investor interest in office is very idiosyncratic, and Greg articulated a few areas. There's certain very tough markets. Take Washington, D.C. I don't think there's a lot of investors racing to do a lot of allocation to D.C. office, and I'd say it's the exception of where New York might be some areas people find appealing, but I'd say that's probably more idiosyncratic or more of an exception than like a broad-based industrial allocation. Okay, I can make industrial allocations to many markets, and I could make money. So that's the way we see it. I don't know, Emmy, if you agree or disagree?
Yeah, I would agree that it's still a very tough market from an institutional perspective. We're seeing almost no interest from most of our investors, but I will say there are a couple out there. They're looking ahead and they're seeing, there's going to be opportunity in office at some point. We know that. The question is where and what does that look like and when's the appropriate time to jump in. But we have a couple people that are ready, really looking to take advantage of, whether it's distress or it's riding, some sort of recovery eventually, or potentially some interesting strategy like a conversion. But the majority of our clients are simply staying away, and many of them, simply still need to shrink their allocation to office, so they're really not looking to do any more.
And that's mostly historic exposure to office, things that they've done in
Yeah.
the past, right? Yeah.
Yes, exactly.
Makes a lot of sense. I do have another question from the crowd around co-GP, and I think, Greg, this is something that is going to be more geared toward your way. In your experience with GP deals, what are kind of the main factors you're looking for when you select a GP partner?
I mean, on the GP front, I think it's relatively straightforward. You're really just looking for someone who has some kind of demonstrated competitive advantage or deep insight into their specific market and asset class. As an investor nationally, we can't be the on the ground experts everywhere. So that's really what you want your GP investor to be able to do. We're often investing in kind of more emerging sponsor type GP partnerships. So, it's okay for someone like us if they don't have a very extensive track record, but it's that demonstrated knowledge as well as kind of the intangibles like work ethic and relationships and things like that. I know Jim, you said you were also investing in co-GP deals as well. So I'm curious if you have any different take.
Yeah.
That was really well said, Greg, and very similar. We probably do less co-GPs than you do, but most of what we've been an LP first. So we underwrote them as an LP. So if you're a sponsor, whether it's an LP or a co-GP, it's probably going to be a similar analysis that the institution will pursue in evaluating you.
Cool. Emmy, I'll let you take this one. Some would argue it's more, but we're seeing somewhere around $600 billion in CRE loans maturing this year. Some would argue it's a little bit higher than this. Historically, real estate entrepreneurs have a really good relationship with refinancing, right? And this is something that has really helped kind of grow the industry very quickly. How does that work in a market like this? Like, what are the challenges around it? How are you looking at refi in general? And even more specifically, what you're looking for in Hateman?
Yeah, well, so what we're seeing is the lenders are really for the most part, very interested in working with the borrowers. And we're actually on both sides of the equation. We're a borrower, but we're also a lender. And on both sides, I would say there's a great desire to work things out rather than taking the keys back. There's a lot of extend and pretend going on, to be honest, right? Which we've seen in the past. So I think, we keep seeing every year we see that wall of maturities chart that everyone shows, and every year it's sort of pushed out a little more. Some of it gets worked through, but some of it gets pushed out again and again. So I feel like we're going to keep seeing that for a while. But again, I think you are seeing some distressed opportunities come to the market, and those can be interesting or not. But in general, I'd say a lot of that's getting sort of worked out behind the scenes. There's a great desire to do that. So it's not this avalanche of distress that many were expecting. I know there's a lot of fundraising around taking advantage of distressed opportunities, and outside of the office sector where things, really are much more dire. We are seeing, that it's not too bad of a situation in terms of the refis and the maturities.
Yeah, and I think again, I'll let Jim walk right through this note of mine. But I think what we're seeing that is different. Again, it's very different. It's not 08, okay? But I remember I was pretty young, but I remember in 08 that everybody took the keys, right? And that created a serious issue. Jim, how are you seeing this relationship that Emmy just talked about between lenders and borrowers and them finding the middle ground? Like, how do you see that working, especially when you're looking at the market right now through principal?
I'll start on a macro basis. I think there's always people have a premise that a distressed situation will result in an opportunistic return for the buyer. That's often not the case. I mean, we have looked at many multifamily transactions where the borrower's in default. It might be a maturity default or a payment default, but it's fully marketed. It's a lease core transaction, and the buyer is buying it on a core return. So I think one of it is yeah, there's distressed situations, but that doesn't automatically result in an opportunistic return. But I do, particularly in the office, there are, you articulated it rather well. Most of it is some consensual disposition where the lender might go to the existing borrower, hey, can you market it? I'll do a discounted sale. And again, you look at the result of that. It's a pricing at market, and that market might provide for an opportunistic return, a core return, or what have you. So I am in Emmy's camp that I don't think it's going to be low-hanging fruit where there's all these defaults are going to result in these fantastic returns. Yeah. If you buy a troubled situation, you're going to have to earn your way out of it. It's not going to be a free lunch.
But how does that, and again, maybe for you both, for Jim and Emmy, maybe like how does that work with, extend and pretend? How long can we do that? How long we can just keep extending and pretending, right? When does it stop, or when does it actually mature?
Emmy, why don't you go ahead? I'm not sure I have a great answer for that, but Emmy.
I'm not sure either, to be honest. I think you can kick the can down the road for a few years, and then you're hoping that something comes in to change the situation. So the capital markets will recover, interest rates will go down so that you're not refinancing at such a higher rate than you were at before. If there's distress at the asset itself, you're hoping that gets resolved. So I think there's a lot of different levers that you're hoping, will create some improvement in the situation and allow you to then refinance at a more attractive basis for both parties.
Yeah, it varies by bank and type of bank. Certainly some of the national banks, you are seeing some office prints, again, in markets like DC and Chicago that are rather ugly, massively under reproduction costs. So I don't think it's non-existent that people realizing the losses. So there's probably more happening than people believe.
Thanks for that. So I am getting a bunch of questions about specific asset classes and about specific regions. I do want to talk a little bit about this regional aspect of real estate happening right now. And Greg, I'm going to let you lead this one. What we've seen in our data is in terms of investment returns, we've seen that Texas kind of led the way. And Texas has been a big investment area, especially for multifamily, right? And comparable to that, Florida has secured the most capital when we're looking at capital raises for 2024. Greg, what are some insights we can draw from this, or more specifically, what are some rising hidden gem regions that you're seeing right now?
Yeah, like the Texas story is interesting just because the reason why everyone's interested in Texas is, I think, because of the generally business-friendly climate and the relative lack of regulation compared to a lot of the coastal markets. But there's two sides to every coin, and the challenge, for just anecdotally, right now I'm looking at a multifamily investment that we're considering in a secondary market in Texas, and the challenge is that because it's relatively lower regulation, you've had 30% increase in supply over the last 2 or 3 years. So even if you don't have to worry about things like rent control necessarily, the supply headwinds are challenging. Now, maybe in that market, we still might do the deal because supply is kind of tapering off, and we would look at investing at something like a 40% discount to replacement cost. But that's kind of the perennial challenge in these more business-friendly environments. The reason why pricing still remains pretty tight on a cap rate basis in a lot of the coastal markets is just because of that lack of supply dynamic. As I said before, we're still very much a bottom up versus top down investor. So we're not like looking at a market and then saying we want to be there and then finding deals. It's usually more the other way around. But we've continued to invest a lot in the Midwest. We still feel like that's kind of a good dynamic where it's a relatively favorable business environment, but it doesn't have those same supply pressures that you see in the Sun Belt. So Our most recent deals have been in Indianapolis, or we've continued to be active in like St. Louis or those kind of markets as well.
Yeah, I mean, how is the regional aspect looking for you at Hateman? Or what are some of those hidden gems that you want to tell
Sure.
everybody about?
Yeah, so I would echo very broadly the Northeast and the Midwest have been regions we really had our eye on because they've been outperforming when you look at apartment market performance, industrial market performance, again, because they've had lower supply. But what I would say is we've done some interesting exercises where we've really vetted all of the markets in the country of above a certain size and really looked at them based on the demographics, the economic drivers, job growth, population growth, all types of factors. And we've identified what we think are a lot of attractive, underrated places. They're typically not in the Sun Belt, so they don't have that kind of sexy Sun Belt image, but the Columbus, Ohio's of the world, Richmond, Virginia, Indianapolis, as Greg said, Madison, Wisconsin. These are some really interesting places of varying sizes that we think are good, ripe for investment and where you can get higher yields than you can in the most in-demand Sunbelt markets. And also we're thinking both near term and then we're thinking longer term. What's going to happen with climate risk? There are places we think are going to be climate change winners, and they're going to be in the Midwest and the Northeast for the most part. So we're really starting to think about including that in our strategy and thinking about what are the places that are attractive for long-term investment.
What do you think about this, Jim? How are you looking from a regional aspect?
It's really interesting. I was a little surprised by the Texas comment. For industrial, the South region has been an ACRE index outperformer. That's been accurate. It has been an underperformer on multifamily housing. If you look at the public REITs, last quarter, last year, where the rents grow, Texas has not been their stronger rent growth market. It's been more the gateway city. So it really varies by individual sector. I always, if you dive into alternatives, okay, what's a primary market for a manufactured housing community? It's Tucson, Arizona. What's a primary market for a student housing? It's Chapel Hill. Now Chapel Hill is a good market for others, but it's so sector specific of where you want to participate. I'd say right now, where is the margin for error the least in an asset class if you wanted to invest broadly in the country? Two of them, retail and industrial. You could make money on a good retail and industrial investment really anywhere in the country. I mean, not that you have to dismiss underwriting, but the standard deviation around the returns, the average returns have been less in those sectors of late. So totally sector specific. If you wanted to say, hey, I want to invest nationally, where's the margin for error the least? I'd say go industrial and retail right now.
I love that comment. Thank you so much, Jim. I'll keep this with you. And this is for all the optimistic investors out there, which has to be most of you if you're doing real estate. But given the projections for GDP growth and inflation hovering around 2%, how optimistic should investor be about capital markets and fundraising specifically in 25? Jim, I'll let you take this one.
Oh, okay. I'm going to tailor this to my some of my friends that are in the fundraising that are on the line. And I know are there. And if you look at us off since 2000, there are kind of three items that have been pretty highly correlated. That's commercial property appreciation or depreciation, total property sales, and fundraising. They're not a perfect correlation, but they've been pretty highly correlated. If you look at 2009, 10, 11, say, wow, that was a very weak fundraising years. People would say, well, they should have been really good fundraising years. If you raised a fund in 2010, spent the money, you would have had a really good success. So, rightly or wrongly, those are highly correlated to one another. And if you look at 2023, 2024, you've had negative appreciation, which doesn't help fundraising. You've had declining property sales. So total respect, for the fundraisers. It's a tough business. It's really hard. The last 2 years have not been easy. If you look at historic patterns since 2000 to 2025, there is a green shoot. Odyssey has had a positive appreciation, very minor for the first time this quarter. NCREIF didn't, but Odyssey did. So that's a green shoot, and that gets investors to believe, okay, we've hit the bottom, and it's up from there. And if you say, okay, the future will repeat fund history again. Okay, rising investment sales market, rising appreciation tends to be better for fundraisers.
Mm-hmm. Yeah, and Emmy, again, only the optimistic take on this one. How's it looking? How's it looking for 2025's capital markets fundraising? What are you seeing?
Well, yeah, again, I would say that there's there's disarray in the macro backdrop and the dislocation in the capital markets, I come back to the fact that property fundamentals are, for the most part, very, very good. So when that happens, that makes it easier for you to have high conviction in a strategy. That makes it easier to move even in an environment when a lot of people are staying back, right? And in fact, you can often make some of your best investments during those periods. So from a capital deployment standpoint, I am hopeful for this year. From a fundraising perspective, again, like I said, we don't have the denominator effect to worry about right now. There are a lot of investors that have increased their allocations to real estate in recent years. So there's capital out there that, again, is sort of waiting for the right time to be committed and then deployed. And so, it sort of remains to be seen. I do think that a lot of that will depend on the macro, what happens this year with the new administration. But again, I think we're reaching a point where people are just ready. My sense of the sentiment in the industry is that people are ready to get moving, right? We've gone through essentially a real estate recession, and people are ready to get back out there, and they're looking for reasons to do that and looking for signs that it's the time. So hopefully that's what will happen in 2025.
Yeah, and Greg, what's your optimistic take on this?
Yeah, I mean, I think in light of a lot of uncertainty in public markets, investors, for better or for worse, like to invest sometimes in less liquid asset classes, and so I think we'll continue to see inflows in real estate. You have seen a lot of fundraising on the debt side this year. I think Blackstone just closed a very large real estate debt fund. So that's I think obviously has good inflows, but that also means that if there's more money coming out on the debt side, that's going to be generally favorable on the equity side, just because that'll compress spreads. So to Emmy's point, I think the fundamentals on the underlying physical real estate have remained relatively strong. So, absent some kind of massive disruption like the continued tariffs issue, but like that really affects more, I think, things on the development side. So, I think we're feeling optimistic in the kind of value add part of the investing world.
Thanks for that. Very optimistic, by the way. I'll definitely take a few quotes there. So I am going to take one question from the crowd here, and this is actually an interesting one. And I think Emmy, you can kind of lead that, and then we'll see how it goes. But so with shifts in labor market, including federal government layoffs and broader employment trends, how could workforce dynamic really impact confidence of your investors or asset demand? Again, especially when it comes to federal government layoffs and the employment trends happening right now in North America.
Yeah. So as it pertains to the federal government, you kind of have these countervailing forces, because you've got, at the one hand, you have layoffs. On the other hand, you've got the push to get the remaining federal employees into the office. So they're getting rid of office leases at the same time, but they're also then pushing employees back into the offices that they're keeping. So it's not exactly clear what the net impact on like the DC office market is going to be, for instance. But it ties into a broader trend, right? Return to office has gained momentum across the public and private sectors. And we're seeing, groups like Amazon who instituted a 5-day back in the office policy. They had to postpone that in multiple markets, including places like Austin and Nashville, because they simply didn't have enough office space to have everybody back in the office. So, that's creating some net new demand. So while office is still struggling overall, there's certainly a green shoot from RTO that's impacting that. And as we talk about the labor market in general, we're keeping our eye on it. It's been pretty resilient. There are a few cracks showing in there for sure. But so far it's been, fairly resilient. But, if we have seen the balance of power really shifting, and if it continues to shift away from employees to employers, you might have more return to office mandates, people getting back to the office, which would be a positive for that market and that demand. And then in general, of course, we keep our eye on the labor market because it's such an important determinant of real estate demand broadly. So if we're starting to see hiring slow, then we're going to worry about things like apartment demand, starting to slow a little bit and things like that.
Awesome. Thanks for that take. And we are very close to getting to the end of this webinar, but I do want to try to take one more question before we get to kind of the final notes on this. And this is actually pretty interesting. And it's been a conversation, the looming broader recession possibility, right? That has started kind of gaining traction in the US. How does that kind of interact with the perceived real estate recession recovery? And Jim, I'm going to let you take this one.
It's a really good question. If you believed, a recession or low GDP growth, you might have low GDP growth without a recession. You might allocate to sectors that have low correlation to GDP growth. What are those? Senior housing would be one of them. Single family rental, student housing. So you would allocate to sectors that might be less vulnerable to less of a correlation to GDP growth. Office certainly has a high correlation to GDP growth. You might get a little bit more cautious about office. So if that was your thesis, that yes, we're entering a recession or a low GDP growth type of situation, you would sector rotate slightly into those sectors that are less impacted by GDP growth.
I think maybe to make a kind of a controversial take versus what Jim said, I would agree that in kind of a vacuum, like yes, office would be more impacted than things like multifamily or kind of specialty housing type markets in a recessionary environment. But I think the key differentiator, especially when you compare going into a recession in today's environment versus going into a recession circa 2019 or circa 2006, is that the difference in cap rates between those sectors have massively changed. So when we're looking at doing office investment now, we're talking about investing in like the mid-teens cap. So even with debt being relatively more expensive than it was before COVID, there's still much more substantial debt service coverage ratios on the office side, versus multifamily where, it's usually 1.25 or something like that. So even if there's, I agree, like the revenue is probably going to be more at risk on office. I think because of where you can get a deal done nowadays in the office sector, it may in fact be more resilient just because of your margin of safety relative to your debt costs.
Thanks for that, Greg. And we are going to jump into kind of the last question for this panel. We're going to go one by one. I think this is a good summary of everything we talked about. And, everybody's listening to this webinar. I'm sure they're excited and eager to understand what's going to unravel in 2025. No one here is an oracle. We don't really know, right? But all three of you have made great decisions throughout your career. So I think getting some sort of your advice for this audience would be highly beneficial. And Emmy, we're going to start with you with this kind of final questions. What are the biggest risks and opportunities that people should be watching for in 2025? Kind of a summary of everything we've talked about so far.
Yeah, so I think I would say again, the risks are heavily concentrated in kind of the macroeconomic and geopolitical arena, much less so in the property market. So there are clear risks there. We were anticipating a really strong growth under the new administration, and what we've seen in recent weeks, has kind of shaken that confidence and it's obviously shaken the market's confidence. So there are risks there, but I do think there are a lot of opportunities. So as I've said before, most of the property markets are pretty healthy. One very encouraging sign to me is that we've seen new construction starts. So the starts of new projects really come down across most sectors. So that's a huge positive. We think there's opportunity to take advantage of buying high quality assets at a time of capital market dislocation. In many cases, we've been able to buy attractive assets below replacement costs. And then there's a very strong outlook, even if there are issues with tariffs and new construction, right? That's going to raise construction costs, which is a positive for existing assets. So again, we see there to be quite a bit of opportunity out there in 2025. And we're looking forward to a more active year.
Thanks so much. I mean, what are your thoughts about this, Greg?
I'll echo Emmy's thoughts that clearly the big risk is around macro issues. So, as I've said before, I think the thing to do is just remain focused on blocking and tackling. So making sure that, we're really at good spreads to market on our real estate investments, and then making sure that we're also financing ourselves appropriately. So, especially if there's concern around entering into a recessionary environment or something where there's potentially going to be more constraints on future refinancing, making sure that we're doing our deals where we are either borrowing long-term fixed rate debt, or if we're going to provide subordinated financing, making sure that we have match term on the back end for us.
Amazing. And then last one, but not least, Jim, you're going to close this up for us. Risks and opportunities for 25. Let the audience know what you think.
As a private equity person, rapidly rising interest rates is the risk. I answer the question the same way over the last 27 years. That stalls the transaction market. So anything that might cause that is problematic in the transaction arena. On the opportunity side, it's on some levels it's pretty simplistic. The most robust opportunities tend to follow that sector that has the worst investor sentiment, and that's office. In 2020, it was retail. Today, it's office. So I think if and Greg articulated well, if you buy office at a 15 cap, that might compensate you for the risk you're taking. So I think that there will be more abundant dislocated opportunities in office than any other sector.
Love that. Emmy, Jim, Greg, thank you so much for letting me moderate this and getting all your insights to our questions about the report. And yeah, I'm going to take it off to Will from BizNow to close us up.
Excellent. Well, thank you all so much. We'll wrap it up there. Terrific discussion, as always. Fantastic panel. Thank you all so much for joining us. We are out of time, but thanks again for everybody. Thanks to the audience for tuning in, making BizNow a part of your day. If you missed part of the panel, don't worry. Like I said, we'll email it to replay right after we wrap up here, and you can always find this and all the other BizNow stuff, biznow.com/webinars. My name is Will Follett. Thanks again for joining us, and have a fantastic day.